in 2025, the federal, state, and gift tax exemption is $15 million per person. Those limits are as high as they've ever been. 10 years, 15 years, and it could very easily be lower than the numbers we're talking about now, which means more money would be subject to estate tax if you didn't do this kind of planning.
It's so important what stuff you put in the trust, and that's the whole purpose of this podcast, because those trusts, you can put stuff in there that avoids taxes completely. You can put stuff in there that's a tax nightmare. There's two types of trust: revocable trust and irrevocable trust.
So what assets are going to grow? Life insurance is the number one example.
Do not put them inside of an irrevocable trust. Worst decision ever. Well, Ben, so today's estate planning environment it presents a lot of opportunity with the limits being so high. So, walk us through what are the limits, and specifically let's cut through the noise. What are the different kind of trusts that are out there? What type of trusts actually matter for these limits, and what type of trusts don't?
Yeah, just taking a step back, right now, in 2025, the federal, state, and gift tax exemption is $15 million per person. So if you're married, it's $30 million you and your spouse as a household. What that means is you can pass with that $30 million number before you're realizing any estate tax. And estate tax is a flat 40% on any assets that are above that level. Now, any money that goes to charity is completely tax-free, and any money that goes to your spouse is tax-free. So we're really talking, Matt, about the death of the second spouse, assets that are moving to the next generation. If they're over that $30 million limit, you're paying 40% estate tax on whatever that amount is. And like you said, those limits are as high as they've ever been, $15 million per person.
Yeah, so 30 million is a couple. So let's talk about, what's the purpose of a trust? So there's two types of trusts. There's a revocable trust and an irrevocable trust. And regardless of what type of trust we're talking about, one of the main reasons why you should use a trust: you manage, protect, control assets, decide how and when the wealth passes heirs, reduce estate taxes, or achieve charitable business or family goals. So just as an example, if to dumb this down, if you had $2 million in kids and you pass the money to kids with no trust, that money, if it doesn't have a direct beneficiary on it, it's going to go through a process called probate. And so what probate means is a court system's now involved. They first make sure, are there any creditors or debtors? They get their money first, and then it takes months long process. Maybe your kids don't know what they're doing, so they have to hire, someone expensive to help them to go out. Now everything's really a legal court document, and so now your kids could be subjects of predators, if they're young and have that much money.
Yeah,
so,
it's technically public record as well.
Yep, absolutely. So a revocable trust, if you do nothing, is going to shield that process. If your assets are labeled in a revocable trust, you can change your mind any day. So, meaning you can change who it goes to, who's the trustee if you die. That, at least we avoid the probate conversation, and the money can then turn into an irrevocable trust when you die. So if you have young kids and you're like, well, I want my uncle to oversee this, or a corporate trustee to oversee this until at least my kids are 30, they can use the money for a HEM standard, so health, education, maintenance, and support, anytime, but then it's going to be interest only, maybe till they're 35. You can lay out the groundwork, the framework for the rules of the money. It's basically how you'd want your kids to use the money responsibly when you're not here. That's the whole idea behind the trust. But a revocable trust really doesn't do anything from a estate planning perspective. It's all included in your estate. So if you're worth $2 million and $1.5 million is in a revocable trust, $500,000's out, it doesn't matter. All
your estate's
still
$2 million.
So the purpose of this podcast is to talk about an irrevocable trust. Now, irrevocable trust means you're gifting the money while you're living, and once it goes in there, you're assigning control to a trustee. Now, you could do what's called a spousal life access trust, which is one of the best of both worlds, where your spouse is in control of the money, and the spouse can use that money for the benefit of you and her, or your partner. No matter what, if it's a traditional irrevocable trust and it's someone else, that trustee is in control of any changes that are made. Once you've put the money or assets in there, you cannot make the changes. The trustee would have to make the changes. So let's talk
Yeah.
about.
So just real quick, back to that original example. If you had $2 million in your estate, you moved 1.5 million into the irrevocable trust. You have 500 in your name. Eventually, when you pass, your estate's going to say 500,000, right? Because all that money that was in the trust is therefore out of your estate, the irrevocable trust.
If it was the irrevocable trust, yeah. So there's 3 real main roles that you need. So Ben, walk us through those: the grantor, trustee, and beneficiary. What do these mean, and what's the importance behind them?
Yeah. So the grantor is the person who actually creates the trust and is the one transferring the assets into it, whether that's life insurance, investment account. Again, we'll get into that in a little bit more, but they're the one who sets the terms. So who's the beneficiary? How do distributions work? When the trust ends, what the provisions are, things like that. They're the ones who are actually giving up ownership and control of the assets once they're transferred. They still may pay income tax on any of the trust income if it's structured as a grantor trust, but that's basically the one who's in control of it is the grantor. The trustee is the person or sometimes the institution that's responsible for managing the assets inside the trust. It could be an individual, so whether that's a family member, an advisor, a friend. It can also be a corporate trustee. Sometimes you see a bank or a trust company listed as trustee for the assets. The trustee has a fiduciary duty to always act in the best interest of the trust beneficiaries and then to follow the trust instructions exactly as noted. They're the ones that handle all the investing, the record keeping. An irrevocable trust has to file its own tax return, so they handle all the filings there. And then they're in charge of the distributions and the requests that are related to that. Then the beneficiary, pretty self-explanatory, but that's the person or the group that's receiving the benefits from the trust, whether that's income in the form of dividends or interest, or whether that's principal distributions. That could be an individual. It could be multiple individuals. It could be a charity. The beneficiaries don't actually own the trust assets. They just have a right to benefit from them. So they're not included in their estate from that once the money's in the trust, if that makes sense.
Absolutely. So real quick before we go through the, what assets should go, what assets should stay out, let's talk about the difference between a grantor and a non-grantor trust real quick. So a grantor, because once you establish an irrevocable trust, the rich person, the person like putting the money in, can decide the tax status, right? So a grantor trust, if someone's worth $50 million and they move $15 million into the irrevocable trust, they can make it a grantor trust. So if they want to maximize that $15 million, if that's made up of stocks and some interest bearing stuff, that stuff's going to produce tax reporting every year. And so a grantor trust means that the rich person could pay the tax liability. So if it's $15 million and let's say they're smart and they put in the most of what they should in the account, but you still owe $15 million, 1% of the account, $150,000 gets reported as income. The $150,000 would flow back to the rich person's tax return. And so all $15 million would stay in the trust plus the growth. So the absolute maximum amount would be passed on to the beneficiaries when he dies. Well, it's technically already passed on because it's irrevocable trust means it's a completed gift. So this is intentional if you're trying to maximize how much tax-free money is going to your beneficiaries. Now, a non-grantor trust means, okay, I'm given the $15 million and it's on the trust to pay the taxes. So non-grantor trust means the tax itself has to perform its own form 1041, its own trust tax return. And it's very compressed brackets. I mean, you go in the highest, the 37% rate, around 15,000 plus of income. So you hit that pretty quick. So the reason I want to bring this up is it's so important what stuff you put in the trust. And that's the whole purpose of this podcast, because those trusts, the government knows they're not getting a second bite at the apple. Once the money's in their irrevocable, it's out of your estate. They're not attacking 40% of that. That 15 million could grow to 100 million, and the 100 million is all going to the beneficiary tax-free. So while the money's in there, the government's attacking at the highest tax bracket. So what you put in there, you can put stuff in there that avoids taxes completely. You can put stuff in there that's a tax nightmare. So let's talk about let's go back and forth here. What is ideal and what is not ideal? So let's first talk about what should go into an irrevocable trust. Ben, you start us out with number 1.
Yeah, first thing would be life insurance. This is one of the most common things that you see owned by a trust, because you pay premiums on a life insurance policy, and then when you die, the death benefit pays out tax-free. So super high level, you want assets that are going to grow. Kind of like you said, if you put something with 15 million, it grows to 100 million. That 100 completely avoids estate tax. So what assets are going to grow? Life insurance is the number one example. Death benefit pays out when you die. Everyone dies. You know that benefit's going to pay out, and that entire death benefit amount is out of your taxable estate if it's owned by a trust. So if there's a $5 million life insurance policy and it's out of your estate, you're avoiding 40% estate tax on that value. So life insurance we see oftentimes in a trust, and then the trustee is the one owning the policy or paying the premiums, often via potentially your annual exclusion. Right now that's $19,000 in 2025. So a lot of
Per
strategies
beneficiary.
per
So you have
beneficiary.
3
Yeah.
kids, you can do $57,000 a year into the trust, and you can use that $57,000 to buy a permanent life insurance policy. So let's talk about. I want to go drill down a little bit more detail on this. So the term, whole life, or permanent universal life, whatever. So if you do, a lot of times we recommend a term life insurance policy should be inside of a irrevocable life insurance trust, an ILIT. And the reason for this, if let's say a client's worth, let's say it's a high income earning physician, like a neurosurgeon making $1 million, they're worth $15 million, but their life insurance, they have a term life insurance policy that's worth $10 million. The spouse, they have 5 kids. The spouse has $6 million of life insurance, and they're rapidly accumulating money, like they're saving a ton. So if they die today, the $15 million between the houses and investments, plus the $10 million in the life insurance. Now, life insurance is tax-free from an income perspective. It's not tax-free from an estate if you die perspective, if you're above the limits. If you die under the limits, it's tax-free. If you die over the limits, it's includable as part of that total $30 million bucket. So in this example, this neurosurgeon, 15 million plus 10 of the term life plus 6 on the spouse, we're at 31 million. So if they don't do any trust planning, 30 million goes to the kids tax-free. The other million that's above the 30, that 400 grand is gone. So is it worth setting up an irrevocable life insurance trust just to hold half of the term life insurance? Absolutely, because every year that neurosurgeon family accumulates money, they're going above and above. And if God forbid something happens along the way, let's say fast forward, they're worth 40 million, and out of the 40, 15 is just term life insurance if they die. So they're really not worth 25. Having 10 in there, it means everything's tax-free. Everything that's left in the 30 million that's left in their estate is under the exemption. The 10 million, because they put it in the trust, that's out of the estate. So now $40 million goes tax-free. Versus if they don't, 30 million is tax-free. The 10 million above is taxed at 40%. $4 million is wiped off the table.
Exactly. And keep in mind, we're doing all these calculations with the limits as high as they have ever been.
Right.
30 million. If you die in 10 years, 15 years, who knows what that limit will be. I mean, this is as high as it's ever been. It could very easily be lower than the numbers we're talking about now, which means more money is, technically out of your estate, and more money would be subject to estate tax if you didn't do this kind of planning.
Okay. So the whole life, or the universal life, this is great because this isn't just like a temporary Band-Aid, like the term life insurance that expires in 20 years. Like this is going to be a permanent death benefit. Like you mentioned, you can use the exclusions, the premium amounts. If you have 5 kids, 5 times 19, that's $95,000 a year. You could put into a policy that's probably going to purchase, at least $7 or $8 million of permanent life insurance, and that's immediately established, and that's going to grow if structured properly. And that doesn't mean that's what you should do. We're just talking about options, but that would be a tax-free way. No taxes, you get the money in the trust. It's just under that kind of like a 401k is a limit of what you can fund. The gifting has a limit of what you can fund. That doesn't affect your lifetime limits. That's an easy one. So that's the life insurance. That's number one. So number 2 is investment accounts. And I want to say specifically, investment accounts are great. However, we prefer individual stocks and a direct index platform, because if you have a mutual fund and a irrevocable trust, and that mutual fund spits out capital gain distributions, it's a nightmare. If it's short term, or if it's interest, it's going to be taxed at 37%.
So it's a nightmare because you, as the investment account owner, don't have control of when that mutual fund manager is making trades inside of the fund. So they could be kicking off a capital gain or selling a fund and transitioning to a new fund you have no control over it. And again, like you said, in a trust, that 37% tax rate comes really quickly. So you just don't have that control.
Just an example, you throw $1 million in a mutual fund there. They have the manager decides I want to rebalance. We're too high in tech stocks, and we're gonna sell these off. And you didn't use a cent. You didn't spend a cent. Suddenly, you have a $200,000 capital gain distribution. Some of it short term. Maybe you're gonna owe $70,000 in taxes. Like what? I didn't even. Your $1 million didn't even grow. In some cases, I didn't use any of the money. Why do I owe tax? Well, that's the mechanics of a mutual fund. Do not put a mutual fund inside of an irrevocable trust. Worst decision ever. ETF's much better. The best thing, have a stock portfolio that's direct index that mirrors an index, mirrors like what an ETF does, that diversification asset allocation, tax loss harvest in it. Ideally, you're not paying any taxes because you're not paying taxes on stocks unless you sell them. And in the direct index, you're actually tax loss harvesting. So you're creating, and those will flow through back the way they would on a regular return, especially if it's a grantor trust. So gains can get offset by losses, and you're still getting those index returns while you do. So we have a whole podcast specifically on direct indexing. That is literally a program that's it's like a match made in heaven for an irrevocable trust. We want the best investments in an irrevocable trust that's stock oriented, growth oriented. And plus, the irrevocable trust, you want something that's going to grow. If you use your exemption, you want that 15 to turn into 30, to turn into 60. If you're really young, maybe to turn into 120, because all that money's out of your estate. So you're not only you're not paying, ideally not paying tax along the way. If you have a really good tax loss harvesting strategy, your kid aren't paying taxes when you die as well. Now, the only argument against putting a stock inside of a trust is if you die now, you get a step up in basis if it's out of your estate. But if you're getting a 40% haircut on that, who cares? And if you're tax loss harvesting, you're naturally stepping up your basis as you tax loss harvest and realize gains that at a net zero tax result. Okay, so those are by far, I would say 90% of the time, what we recommend. Business interest, I should say, is heavily in there. So I would say life insurance, investment accounts, business. If you own a business, privately owned business, moving that into trust can sometimes be a no-brainer. Match that with QSBS, it's like you're avoiding all kinds of taxes. But more common, non-business owners, Ben, what's number 3 that we see?
Yeah, we see a lot of real estate, and now that's not really including a primary residence, because primary residence, if you move that in a trust, you can lose certain tax breaks like the homestead exemption or a capital gains exclusion, things like that. So really, like a vacation home, if you have a rental property, it makes a lot of sense to maybe move that into a trust, depending on your situation. There's a lot of asset protection and just general estate planning benefits that you can have by moving a non-primary residence into a trust ownership.
Yep. And we talked about the business interest already, but this can be huge because especially if you're operating the business, let's say, and you're planning on doing the next 20 years, you move 10% of your business interest in a trust. That trust actually get 10% of the profits, which is a good thing because then you've used your gift exemption one time, and then the trust is going to build up heavily over time as well. So you get the best of both worlds if you're still operating, or if you move it in at a low valuation, then suddenly, a couple years down the line, it sells for a bigger valuation. Maybe you've moved $1 million of your exemption, and suddenly it's selling for $5 million. It only costs you $1 million of your exemption to get in, and now you have $5 million out of your estate.
Exactly.
So, then the last thing would be, high growth or unique assets. So this could be startup shares, crypto, private investments. Not, for example, if you have a friend that started up like a med tech startup or something, you invested 50 grand there, and it's expected if it hits to hit 10x. That could be something, maybe even if you have enough kids, if you have 3 kids, you just use your lifetime exemption. You use your freebie, the 19 times 3. You move that 50,000 in there, and then if it hits at 10x, or you haven't used any of your exemption, you're under the gifting limits, and then suddenly you have $500,000 out of your estate that then can get invested in a direct index platform. Hopefully that's in a slat, so you or your spouse have access to that even while you're living. You get the best of both worlds there.
Yeah, I would say just biggest thing here, assets that you think are going to grow, and the timing on this. Try to do this if you can while these exemption limits are so high. There's just no guarantee that they're going to stay as high as they are right now.
No question. So let's talk about the absolute worst things you could put into an irrevocable trust. Ben, what's number 1?
Number 1 for me is just a qualified retirement account like an IRA or a 401k. You can't transfer that into a trust without triggering any sort of income tax. Easiest way to do this would be instead just name the trust as a beneficiary. Name the IRA or 401k as a beneficiary.
on the IRA, name the benefit. We know it's what you meant, not what you
We're
say.
cutting that up, but
Keep it in, keep it in, keep it in. No, it's good. Go ahead.
instead, it's important to name the trust as a beneficiary of the IRA, or the IRA that's holding an old 401k balance. That's going to be a lot cleaner, and you're avoiding any of that tax.
Yeah, and just to further your point, Ben, if someone wanted to move their IRA into a trust, not only if you're under 60, you're paying the tax, ordinary income tax plus a 10% penalty. You literally have to rip it out and then put it in. Dumbest idea ever. And if you name the trust as the beneficiary, you have to be careful with the Secure 2.0 Act because of the rule of the 10 years. You have to get the money out. So the trust has to be structured properly to fulfill the requirements where the money has to be out of there in 10 years. Now with the Secure 2.0 Act. So I'd say second one would be primary residence. There are sometimes, if you're like Medicaid planning, like asset spend down planning, if your spouse has died, if you want to protect like an asset protection trust, there are use cases, but in general, not your primary house shouldn't be moved into a revocable trust because you're going to lose control. Some tax breaks could be lost, etc. That's not a 100% black or white, don't move. But if you're a high net worth individual, your primary residence is probably not a highly appreciating asset. There's lots of other assets to be a greater fit for you. So what's number 3?
Yeah, I just in general, bank accounts, cash reserves, assets that you feel like you need for daily living. You don't want to move those into a new revocable trust because you're just giving up control of those assets. So you want to retain those for liquidity, for taxes, for emergencies, things like that. You don't want that necessarily in a trust and having a trustee oversee any of that.
Yeah, and I'd say last but not least, it's probably obvious, but assets with debts or liens on them, it may trigger due on sale clauses. It's administrative nightmare in cases. That'd be a no-go as well. So, okay, well, just wrapping it up. So I think a couple key takeaways. So, the purpose of a trust: control, ownership, benefit among, distinct parties. You're basically, if something happens to you, you're making sure that your wishes for your family or kids are protected, making sure they're protected against other risks that are out there. Your irrevocable trust in general, you're trading flexibility for long-term tax and asset protection. With the exception of a SLAT, you can get the best of both worlds. And then let's talk about this new tax code, Ben. So if you give us an example, if we're under the 15, then let's say, now right now it's set in the tax code, but let's say in 10 years you use 5 million and the exemption goes down to 5 million. What does that mean for you? What's the result?
It means you've basically used your exemption, right? So you don't have the ability to go back and retroactively say like, hey, 10 years ago this thing was 15 million, so I can't give another 10 million. That's why you need to use these exemption limits while they're so high now. There's no retroactive gifting saying, hey, like the limit used to be 15 million. Can I go back? No, that you can't. So that's why it's so important while these limits are so high, if you are considering this type of planning, to really consult with your estate attorney. And
So I would say 2 use cases. If you're high net worth, young, high income, already high net worth, but like you don't have an estate planning problem today. Like, let's say your net worth's like 5 million, but you're in your like early 40s and you're just crushing it, and your expected net worth's going to be well above that. Our recommendation is don't move like a lump sum in. Let's start planning through cash flows. If you have kids, the lifetime exemptions. If you have 2 kids, let's use the 19 and 19 that you can do. Let's use the 19 and 19 that your spouse can do. Let's use that.
And so just taking a step back, just so we're clear, that 19,000 per person, that's the annual exclusion limit right now in 2025. That means that I can give you 19,000 without having to file what's called a form 709. It's this big filing thing. There's no gift tax reporting. It doesn't count towards our lifetime limit. So that's the limit that we have to get up to without having to deal with any sort of reporting. That's why it's called that freebie.
Yeah, I give them $19,001. I'm filling out that form. If I'm give them 19,000 or less, no form. It's the freebie. So if you're young and you expect to have an estate planning problem, slats would be a good. If you're married, 2 kids, the husband's putting in 38 a year, 19 to 19 for each kid. The wife's putting in 19 to 19 to each other's slats, which they'll have control of. If they don't need it, it's out of your estate. It's asset protected. It's direct index. It's super tax efficient as it would be if it was in your estate. Those are no-brainers if you have the cash flow. The other thing is if you're high net worth, if you're above that $30 million now, or let's say you're 50 or 100 million, is making the decision, does it make sense to use your and your spouse's 15 million if you haven't already used that 30 million do the estate planning today, get the money out of your estate, because then all the appreciation is out of your estate forever, and you're avoiding that 40%, and whatever's left, you and your spouse spend down. And the benefit of that really is two things. Compounding interest is out of your estate, plus if limits go down, you've grandfathered yourself into one of the highest estate planning environments that we've seen. So any questions on this, please reach out. We're happy to do a free consultation with you if you're not already an existing client, and walk through what would be the best use of an irrevocable trust if it makes sense for your individual situation.